Okay, good day guys. Again, this is part 4, which is manufacturing overheads. The first part was the introduction, the second part was material, the third part was labor, and the last part of the module is manufacturing overhead. Now the first thing we need to know is that manufacturing overheads are divided into two, which is fixed manufacturing overheads and variable manufacturing overheads. So we are going to do calculations on both fixed and variable, but let's start with the variable. Okay, when you calculate the variances in variable manufacturing overheads, you must know that you will have two formulas to work on. Okay, the first one is variable overhead rate variance. So the focus here is rate, whereby we are going to compare standard rate and actual rate. So this is the formula. Standard rate minus actual rate times actual time. Okay, remember when we are talking about the rate, you'll always have time because the rate always goes with time. Okay, is standard rate minus actual rate times actual time. And then the second formula, we are going to calculate variable overhead efficiency variance. Remember, efficiency, we said we're talking about time, so we are going to compare standard time and actual time. So the formula will be standard time minus actual time times standard rate. Okay. So the tricky part with this one, with the variable manufacturing overhead, is that you have a separate calculation for standard rate. You also have a separate calculation for actual rate. Okay, actual time is always actual time worked, but these ones you have to calculate them. All right, how do you calculate them? Let's start with the first one, the standard rate. To calculate standard rate, when you are dealing with variable overheads, standard rate will be your budgeted variable overheads over your budgeted labor hours. So it's overheads divided labor hours. Overheads is variable overheads divided by labor hours. Which ones? The budgeted ones. Okay, the budgeted ones. And then when you have to calculate your actual rate, it's the same thing. It's your variable overheads divided by labor hours. Which ones? The actual ones. Okay, please don't forget this. Let's look at the calculations so that we can get a better understanding of what I'm talking about. Okay, let's go to the next slide. Okay, now the same principle takes place here. You will always be given standard and actual information. So you need to use that information that is given to you in the formulas. The only thing you need is the formulas. You need to know the formulas. So for this exercise, you can look at example 3.6, study example 3.6 on page 96. Okay, but now let's do the activity or the exercise on page 108 of your textbook, activity 3.10. Let's go there quickly. Page 108, activity 3.10. So they ask you to calculate a variable overhead rate variance. Okay, don't confuse these two V's. This is variable. A variable is something that changes. and variance is what? Is the difference. So it's a variable overhead rate variance. So what is our focus there? What is our focus? Our focus is what? Our focus is it's a rate. So what do we compare? We compare standard rate and actual rate. So the formula will be variable overhead rate variance, which is equal to standard rate minus actual rate times times actual time. Sorry. All right. Now remember, we said when we are doing variable overheads, the standard rate and actual rate are not the normal one you previously calculated. They have their own calculation. And then from the previous slide we said standard rate will be your budgeted variable overheads divided by budgeted labor. Okay, let's go to the exercise quickly on page 108 and look for budgeted variable overhead. Budgeted, there is budgeted information. You have fixed overheads 38,500. We have variable overheads, which is 20,250. So we have 20,250 budgeted variable overheads divided by budgeted labor hours. Go to budgeted information. There is labor hours 350. Okay, and then when you do the calculation there, and then we are left with 57 rand 86 cents. Okay, and then minus actual rate. How do you calculate actual rate? It's the same procedure. You take actual variable overheads divided by actual labor hours. Okay, where is you go to actual information and look for actual variable overheads. It's 26,500. There you go. Divided by actual labor hours. How many hours were worked? We actually worked 400 labor hours were clocked or worked at a total of 18,000. So the hours worked were 400 times actual hours. How many actual hours were worked? Actual information, 400 labor hours were clocked. So it's 400. You do the calculation and then you will remain with 66 rand 25 cents, right? And then times actual time, right? You can see from here whether the answer is going to be favorable or unfavorable. This is standard, which is planning. This is actual. So actual, when actual is greater than standard, then we will have unfavorable variance, right? So we planned to pay for variable overheads to pay overhead to pay 57 and 86 cents, but we actually paid 66.25 cents, which is more than what we planned. So we had to put more money, which is 8 rand 39 cents, which is unfavorable to us, because this 8 rand 39 cents we could have used it to pay or buy something else, right? Multiplied by actual time, then it gives us a deficit of minus 3,356 rand unfavorable variance. Remember, always you must state whether your variance is favorable or unfavorable. Okay, please don't forget that. Okay, let's go to the next slide. Don't forget that when we are dealing with variable overheads, the standard rate and the actual rate is not the normal one. We have to calculate it. So you need to know how to calculate it from the previous slide. Okay, you can also get that from your notes, right? The next slide. Actually, this was the first one for variable overheads, first formula. The second one will be the second one will be your variable overhead, efficiency, variance. Okay, remember efficiency, time. Okay, so we are going to compare standard time and actual time. So your formula will be standard time minus actual time times standard rate. Okay, so when you do efficiency again here, remember we extended the formula when we did my material quantity variance. We also extended the formula when we did labor efficiency variance. We also here extend the formula when we're doing a variable overhead efficiency variance. Okay, which part do we extend? We extend standard time. Okay, how do we extend it? We say standard time times actual units produced. Okay, this whole part is only this one, and then minus actual time times standard rate times standard rate. Right, let's substitute with the figures. Okay, how much is our standard time? Go to standard information in your exercise. Standard information, we're talking about labor. Okay, now we have 2.5 labor hours are required to produce 1 unit at a standard rate of 30 Rand per hour. So our standard time is 2 hours 30 minutes, 2.5. Okay, so it's 2.5, 2.5, 2 hours 30 minutes. Alright, multiplied by actual units produced. Go to actual information or records. How many units were made or produced? 150 units were produced. Okay, so times 100 units and 50 units that were produced minus actual time. How much time was spent to produce? 150 units were produced, 3,300 kg of sugar, no, 1,100 sugar were 400 labor hours were clocked. So our actual time is 400 hours. Okay, and then multiplied by standard rate. Remember, standard rate has its own formula. We did calculate it in the previous example, and then we discovered it is 57 Rand 86 cents. But if you want, you can also do it. Okay, you take the standard rate, you take the budgeted variable overheads, and you divide it by budgeted labor hours. You will get this money. Okay, then you do the calculation. You can see from the bracket which one the answer will be favorable or unfavorable. So our actual is greater than our standard or planning, so that means our planning falls short. We have to add more money. We have to add more more hours. Okay, because according to planning 375 hours is the time planned, but actually what the time spent was 400. Okay, so the shortfall is 25 hours. Alright, we have to add 25 hours, which we could have used somewhere else, and multiplied by the standard rate, and then we have a deficit of 1.44650 Rand. Right. Okay, hope that one was also clear. Okay guys, for now we are done calculating the variances for variable overheads. Now we are going to calculate variances for fixed overheads. Okay, let's go to the next slide. So now we are doing fixed overheads variances. Also, when we are doing fixed overheads, we are going to use two formulas. Okay, The first one, we are going to calculate fixed overhead expense variance. Okay, fixed overhead expense variance. So focus expense variance, and then the formula will be a budgeted fixed overhead minus actual fixed overhead. I like to call it before minus after. That is budgeted fixed overhead minus actual fixed overhead, or you can say before minus after. Okay, then the second formula will be calculating fixed overhead volume variance. So our focus is volume. Okay, so the formula, we have two formulas there. You can use this one depending on the information you have. Standard time minus budgeted time times standard rate, or else you can use budgeted fixed overhead or before minus standard fixed overhead 4. Before minus 4. Before minus 4. Okay, let's go to the calculations and see how it goes. Right. Okay, the same procedure also takes place here, whereby you are given standard and actual information is given to you in the question. The only thing you need to do is to use that information in the formulas. The only thing you need to know is the formulas. Okay, let's go to the exercise on page 98. No, sorry, you can study the example 3.7 on page 98, okay, on your own time. Now let's go to the exercise on page 111, activity 3.13. Activity 3.13. Go to your textbook. Go to your textbook. Okay, now they want us to calculate fixed overhead expense variance. So it's an expense. You need to know the formulas by head. Expense. So your formula is gonna be before minus after. Before, which stands for budgeted fixed overhead, minus after, which stands for actual fixed overhead. So let's substitute the figures. Let's go to the exercise and look for budgeted fixed overhead. Okay, let's go to budgeted information. So we have budgeted fixed overheads, which is 43,000, right? 43,000 minus actual fixed overhead. Let's go to actual information and look for actual fixed overheads. So fixed overheads which are actual is 42,300. 42,300. Right. As you can see here, actual budgeted is greater than actual, so that means actual is less than budgeted, right? So meaning we have planned for 43,000 to pay fixed overhead for 43,000 rand, but actually we paid 42,300 with a change of 700. So it's favorable for the company. Okay, that one was very easy. Okay, the next one, which is the last one. Now here they want us to okay, this one is on page 109 of your textbook, exercise 3.11. Page 109, exercise 3.11, page 109, exercise 3.11. They want us to calculate fixed overhead. They want us to calculate fixed overhead volume variance. Remember, we have two formulas there. The first one is standard time minus budgeted time multiplied by standard rate. And the other one is, let me write the other one. The other one is before, that is budgeted fixed overhead, minus 4, that is standard fixed overhead. Okay. So it depends on the information you are given in the question paper whether to use this one or to use this one. Now let's look here on that exercise. Okay, do we have standard time? Yes, we do have standard time is 8 hours. Do we have actual units produced? Let's look there. Actual units. According to its record, the business actually produced 145. Yes, we have. Okay, do we have budgeted time? Let's look under, okay, let's read, maybe we'll find it. Okay, if you look there, 8 labor hours are required to make 1 school bag. The standard rate for labor is 80 rand per hour. The business estimated, that means budgeted, that 942 labor hours will be used. So we have budgeted time, which is 943 hours. Budgeted time 943 hours. Okay, let's start here. Standard time, which is extended to standard time times actual units produced, and then we have actual time, standard time, which is 8 hours, 8 labor hours, and then the units actually produced is 145, and then budgeted time or estimated time is 943 hours, and then the standard rate, they said the 8 labor hours are required, which is standard time, are required to make 1 school bag. The standard rate for labor is 80 rand. So the standard rate is 80 rand. So we can use this formula. We have all that information from the question. Then you do calculation, you get 1.16 and then minus 943 multiplied by 80 rand. You can see from here. You can see from here. Right, the difference is 217 multiplied by standard rate, which is 80 rand, and then it gives us 17,360. Is that true? Let me look at the calculator. This seems impossible. Let me check from the calculator quickly. We have 217. We have 217 multiplied by 80 rand gives us 17,360. Okay. So that's the answer. Okay, so guys, you need to practice this. Okay, sometimes they will give you the budgeted, they'll give you the budgeted what you call it, fixed overheads. They'll also give you in the information the standard fixed overhead, so we are going to use that information. But if you have all this information from your question, then you are good and you are set to go. Well guys, that was it, and that was the end of module 3. I hope everything is clear, and good luck. Sharp, sharp. See you.